Welcome back to Yahoo Finance. U.S. Treasury yields are soaring. Take a look at the 10-year yield, getting a lot of attention this week, breaking back above 4%. Joining us now for more on that, we want to bring in TheoTrade Chief Market Technician Jeff Bierman. Jeff, great to have you again. So you look at this from a technical perspective. We're back above that 4% threshold. What do you think the bond market is signaling to you? And what do you think that means just in terms of the trading action we could potentially see?
Well, there's this fulcrum going on between the Fed raising rates and the Fed, people thinking the Fed's going to hold off rates. And I am more leaning towards what the bond market says than the narrative that comes out from the Fed weekly. I just go by the facts, Seana, and the facts are labor markets are tight, prices are not coming down. We've stabilized. We've come from an 8.5 handle on the inflation rate on the CPI and PPI to about 6, but we bounced back up. So we overshot to the upside. We've stabilized here somewhere between 5, maybe 7% for the time being. And I don't think that fits with the Fed's mandate of that 2%. So the bond market is taking the lead away from the Fed and saying, listen, we're just going to ratchet up rates just in case here. And even if there's a 50 basis point hike that's baked in, the Fed funds futures rate that's priced in is telling you 475. So if we're at a 4 handle now, you may actually see us go up another 75 basis points before we pause once again. But don't think just because we pause, we're going to pivot. We may stay there for a lot longer than most people suspect.
Yeah, we heard Kashkari well into 24 was his guidance there. You mentioned the 10-year there. Any different indicators when it comes to the 2-year now pushing 4.9?
Yeah, here, listen, Dave, look at the 10 against the 2. That's the benchmark that the Fed looks at. Now, I look at the 10 against the 30. That's just me because I look longer term. But the 2 is accelerating at a faster pace on the yield than the 10. Definition, translation, you're in an inverted yield curve, which signals a recession, and we're accelerating into that recession because the delta or the divide between the 2 and the 10 is getting wider and wider by the day. That's why the market's on its heels. It's backing off because it's saying, are we in a recession? Are we not? We're accelerating faster into one based upon the inverted yield curve. That's what I'm seeing.
So, Jeff, what does that mean for portfolio allocation? Should investors be allocating more towards bonds? And that 60-40 that we all know so well hasn't really necessarily been working last year. But should that new narrative be maybe 40-60 in favor of bonds?
You actually might want to up the ante on that, Seana. The 60-40 is the traditional model portfolio of 60% equity concentration, 40% fixed income. But if you're getting a 4 to a 5 handle on a fixed income product that has half as much standard deviation or even half as much systematic beta as, let's say, the stocks, now you're competing for a yield that offers you twice as much, actually almost 3 times as much as the S&P 500 with half the risk. So the mean variance criterion is to simply get the highest yield at the lowest possible risk or maintain the lowest possible risk that offers you the highest yields. And so bonds are now standing you, looking in their face, begging you to buy them. And I think that's a good move. I think investors should actually start to up the ante on perhaps even 55-45, simply because if we take out 3,800, you won't have a hedge to the downside once interest rates start moving up. And so I think investors should start to overweight into bonds right now until we get the all clear signal that the Fed is done raising rates, and we're not even close.
Wow, buckle up. Okay, before we let you go, we understand you have something significant to point out when overlaying hospitality giant Hyatt and biopharma giant Pfizer. What are you seeing, Jeff?
Dave, this is the Seinfeld market. It's the Seinfeld market. If we're going into recession, what's the playbook, everybody? You got to rotate to low beta, defensive stocks with high yields to kind of fight off the downdraft. What's happening here is just the opposite. This is what I call investors who are in the bizarro world. It's the Seinfeld world. They don't even know what they're doing. They're just, hey, let's chase Hyatt all the way up. And if we're going to recession, what makes people think that Hyatt is going to be the beneficiary of recession? And let's shun and avoid Pfizer altogether, with an 8 PE multiple, a 4% yield, and cash flow that, defends in a recession. So like I said, this bifurcation is telling me that investors are chasing performance both up and down and doing very little research. And that type of confusion is being played out because of the narrative that the Fed's kind of hemming and hawing day in and day out. So until value stocks start to make a comeback, and until these growth stocks, which are in the leadership of the markets, leisure and airlines, we don't have a market that has any type of what I call like basis to move that much higher until the financials, technology, and industrials take the lead, which they're not.
It is essentially George Costanza telling a woman, my name is George, I'm unemployed, and I live with my parents. And it worked, Jeff. It's that Seinfeld market. You are a genius. Jeff Bierman, appreciate it, brother.